Well, hello everyone. This is Andrew Mattiacci, the CUSO Financial Services financial advisor located at TBA Credit Union with TBA Investment Services. I'm here today to talk about the CARES Act. If you have any questions about the CARES Act, about retirement planning, about investments in general, you can see my phone number and my email on the screen. Please reach out to me at any time and let me know how I can assist. So before we get into the CARES Act, we're going to talk about real quick some of the highlights of the CARES Act overall, and then dig into some specific provisions that affect what I do on a daily basis, which is help people plan for retirement and deal with IRAs and 401k type plans. But there are many provisions contained in the CARES Act that we are not going to discuss today. Please reach out to myself if you have any questions on those other provisions. Otherwise, we are going to focus on mostly the provisions that affect your retirement plan. The CARES Act stands for the Coronavirus Aid, Relief, and Economic Security Act. It's better known as the Coronavirus Stimulus Package, and it is the largest, by far, the largest economic stimulus package ever. It impacts individuals, businesses, hospitals, governments. Today, we are going to focus on those individuals who own IRAs or 401ks. And we're also going to talk about businesses and how it affects them if they offer 401k or retirement type plans to their employees. The idea with the CARES Act, it was supposed to bolster the economy. That was the main focus. And it was signed into law back on March 27th, 2020. And most of the provisions are effective for the year 2020. As we go through the provisions that affect retirement plans in today's session, I will talk specifically about those provisions and the dates that affect those provisions as well. So we'll get into that in more detail. But first, let's talk about some of the highlights of the CARES Act that did not affect retirement plans. Now, the big headline in the news was those direct payments to tax-paying Americans, those one-time direct deposits of up to $1,200 per person, or married couples receive $2,400 plus the $500 per child. The payments did have some income limitations, as you can see on the screen, but this was one of the big headlines from the CARES Act, were those direct payments. The other big headline from the CARES Act was the enhancement and expansion of the unemployment insurance program. $250 billion thrown into the unemployment program. And the big highlight there was that additional $600 per week of unemployment insurance income that qualifying individuals would receive. And that was $600 on top of what they were receiving from their state program. So quite an enhancement of the unemployment program and also those direct payments. So these were the two big highlights that most people saw in the news. But what we're going to dig into today are some of the other facets of the CARES Act that specifically impact your retirement plan and your investments. And the first one on the list, it's a big one. It is the waiver of the 2020 required minimum distribution. So the required minimum distribution is that distribution that Uncle Sam forces you to take every year once you turn a certain age. We're going to talk about those ages in a moment. But if you have a traditional IRA, a 401k type plan, these are those minimal distributions you've got to take out so Uncle Sam, so the IRS, can collect the tax revenue on that. Well, in 2020, thanks to the CARES Act, you do not have to take your required minimum distribution from a traditional IRA or 401k. So, as I mentioned, this waiver of the required minimum distribution affects owners of traditional, simple, and SEP IRAs, as well as defined contribution plans like 401ks and 403Bs. Also, some 457s are affected as well. Talk to your employer to see if you are one of those who can waive the 2020 RMD if you have a 457. And we're talking about people who are, and these is where the two different ages come into effect. In fact, I'll back up a second before we talk about that. A few weeks back, I did a workshop just like this on something called the Secure Act. So today we're talking about the CARES Act, which was signed, as I mentioned, back in March of 2020. But back in December of 2019, there was a different act called the Secure Act. And the Secure Act changed the age when these required minimum distributions were supposed to happen. So you've got these required minimum distributions, and what used to be the age was 70 and a half. This was the age for years and years. Once you turn 70 and a half, you have to start taking those required minimum distributions. Well, that ended on 12/31/2019. After 12/31/19, which is basically 2020 and beyond, the new age is 72. So we covered this in the Secure Act. A recording of that presentation is listed on the TBA Credit Union website under Investment Services. You can certainly, again, call or email myself and I can send you the link. And that discusses in a little bit more detail the change. But if you are within this time frame, 70 and a half to 72, and if you have any questions on required minimum distribution, certainly let me know. But the key is with the CARES Act that we're discussing today, regardless of your age, 70 and a half, 72 years old, in the year 2020, you don't have to worry about it. There is no required minimum distribution that you have to take from your IRA account, regardless of your age. But if you want to learn more about those age changes, certainly reach out, let me know. And as far as we know, in the year 2021, there will be a required minimum distribution. So it is still good to know when you have to start taking yours based on your birthday. So reach out, let me know if you have any questions on that. This also applies to inherited IRAs as well. So if you have an inherited IRA, which is also a topic we discussed in the other webinar, the Secure Act webinar, if you have an inherited IRA and you are taking required distributions, you can skip it in 2020. Reach out to your tax professional, your CPA, a licensed tax person, if you have more questions on your required minimum distribution, just to make sure you're doing the right thing on your taxes, of course. Now, I've had a lot of people reach out to me after the CARES Act came out, and they said, uh-oh, I already took my 2020 RMD. I already withdrew hundreds or thousands of dollars from my traditional IRA earlier this year in 2020. Paid my taxes on it. What do I do now? Because I didn't really have to do that. So the IRS came out with some notices, and I guess I shouldn't skip past this too much here. The IRA, when you take a required minimum distribution from an IRA account, you typically cannot roll that over. But because of the new law in 2020, there is no required minimum distribution, as we've discussed. So now, if you have already taken a distribution from your traditional IRA this year, you may be able to do a rollover distribution, basically putting that money back in to your IRA. So if you've already taken a distribution from your IRA because you thought you had to take an RMD and you want to try to get it back in, here's how you're going to do that. You can talk to a financial professional like myself and keep your tax person in the loop as well before you make any big decisions like this. But here's what you're going to do. So, and there are some deadlines to keep in mind too if you're going to roll that money back in. So the IRS put out a notice recently that basically says that you have until July 15th. So you've got until July 15th, 2020 to get money back into your traditional IRA and avoid paying taxes on that money. So I'm going to skip down here and take a look at the old rule. You had something called a 60-day rollover. So when you take money out of a traditional IRA and you say, uh-oh, I didn't want to do that. I'm going to get that money back into my traditional IRA so I don't have to pay taxes on it. You've got 60 days to do that, and you can only do that once every 12 months. So under the old rule, if you had taken a distribution on February 1st, you would have had until April 1st to get that money back in to your IRA and avoid taxation on that money. The new rule after the CARES Act came out is that if you took a distribution on, for example, February 1st or any time after February 1st, you've got this deadline of July 15th. So they've pushed back the deadline. You still have time to get money back in. Unfortunately, and we're focusing on distributions since February. So if you've taken a distribution since February from your IRA, you still have time up until July 15th to get money back into your IRA and avoid taxes on that money. However, if you took a distribution from your traditional IRA back in January of 2020, as of right now, that distribution cannot be reversed. There may be new IRS notices coming later this year that changes that, but as of right now, if you've taken a distribution from your IRA in January of 2020, that cannot be reversed. If it was on February 1st or after, you can get that money back into your IRA as a 60-day rollover by July 15th. Next up on the list are coronavirus-related distributions. So we talked about a certain kind of distribution on the previous slides. That was your required minimum distribution that you have to take every year. That's been waived. But what if you need money out of your IRA or your 401k to help pay for bills, medical bills, your mortgage payments? You just need money out of your retirement accounts to help you pay bills because of something that has happened to you during the coronavirus, whether you have COVID-19 or you've been laid off or furloughed. You can take a coronavirus-related distribution, a CRD, and you have a couple of tax advantages now that you didn't have before. So if you take a qualifying CRD, if you take a coronavirus-related distribution and you qualify for it, and we'll talk on the next slide of how you qualify for that, what will happen is the bill will waive, number one, the 10% early withdrawal penalty. So if you're younger than 59 and a half years old and you take money out of a traditional IRA, typically, most of the time, you're going to have a 10% early withdrawal penalty. If you take money now out of a traditional IRA in the year 2020, because of a coronavirus-related distribution, you will not have to pay that 10% early withdrawal penalty for distributions up to $100,000. The other, and this is retroactive back to January 1st, it should be noted. So if you did take a distribution back in January, February, you've already taken it this year. If it was for coronavirus-related purposes, you can avoid the 10% penalty. So that's the first advantage. The second tax advantage is that you are able to spread the taxation of that distribution over 3 years. So if you take $30,000 out of your IRA account this year, you don't have to pay tax on the entire $30,000 this year. You could pay tax on $10,000 of it this year, $10,000 of it next year, $10,000 of it the following year. You could spread that taxation over 3 years, however you would like to do it, and potentially have less of a tax impact. Certainly talk to your CPA, a tax professional, before you take any distributions. Make sure you qualify for the CRD, and then talk about that 3-year tax payoff, because that'll be something that you'll have to do on your taxes for the next 3 years. But if you qualify for a coronavirus-related distribution, you can avoid the early withdrawal penalty and you can spread that taxation over the next 3 years. And this is for distributions made between January 1st and December 31st, 2020. But you do have to qualify for the distribution. And so this is for individuals who have been diagnosed with COVID-19 or have a spouse or dependent that were diagnosed with COVID-19. Or, and here's the catch-all, for individuals who experience adverse financial consequences as a result of being quarantined, furloughed, laid off, having to work reduced hours, being unable to work due to lack of childcare, closing or reducing of hours of a business operated by the individual due to COVID-19, or other factors as determined by the U.S. Treasury Secretary. A lot of things in that third one. This is where, again, I would go and say that you need to speak to a licensed tax professional, CPA. Make sure you qualify for coronavirus-related distribution before withdrawing $50,000 or $100,000 out of your IRA account. Make sure you're going to qualify for the tax relief that the CARES Act gives you. If you do qualify and you need assistance taking those distributions, then certainly contact me or your financial advisor, and we can assist you with taking those distributions. The next item, as far as distribution relief, if you need money to help pay bills during the coronavirus, you have the option from 401k plans, if your employer allows it, to take a loan from your plan. So it used to be that if your employer allows it, not every employer, you don't have to allow your employees to take a loan from the plan, but what it used to be is you could take up to $50,000 or 50% of your vested balance, which whenever one is smaller, basically the lesser of. So the new rule says that you could take up to $100,000 in loans from your work plan, or up to 100% of your vested balance. So basically you could take up to $100,000. Now, the loan distribution must be made within 180 days after the enactment of the CARES Act. Well, the CARES Act was enacted back in March. So you've got until the end of September to take that loan and to qualify for this higher amount. So the advantage of a loan from your employer plan is that you're able to take that money out. You're able to pay that back through payroll deductions. And if you pay it back within 5 years, then you won't owe income tax. So the key advantage here is that it's an income tax-free distribution from your IRA. You've got to put it back in within 5 years. If you don't, then it is taxable. So you contact your employer and see if you qualify. If your employer offers loans, it might be an option for you if you need some additional funds to help pay some bills during these crazy times. In addition, qualified individuals that already have a loan. So if you already have a loan and the repayment on that loan was due on March 27th, all the way through December 31st. Remember, March 27th is the day that the Coronavirus Act was signed. If you had a loan at work through your 401k and the repayment was due between March 27th and December 31st, you can delay the repayments for up to 1 year. Interest will still accrue, but at least you can delay payments and maybe that money can go toward some other bills. Now, those are the distributions and the provisions that affect your retirement plans, the waiver of the required minimum distribution. We've got the tax relief on distributions up to $100,000, not having that penalty tax, and also being able to spread the taxation over 3 years. Those are those coronavirus-related distributions. You've got the additional loans you could take from your work plan as well. If you have any questions on any of this, again, please reach out. Let me know. I'd be happy to talk. Again, my office number and my email are listed below. Otherwise, I appreciate your time today. Thank you for watching, and have a great day.